Ladies and gentlemen, welcome back to your new favorite finance YouTube channel. This is Pandrea Finance. My name is Alex Pandrea and I'm very excited to bring to you today's video. Today we are talking about how we can use options to hedge our positions. Protect your butt basically from a potential market downturn. Nobody likes those, so you gotta protect yourself. This is something every investor and trader needs to know, and once you understand the concept and what strategy works for you, it'll open up a whole new world of ideas, and at the end of the day, you'll lose less money, which I think is a good thing. So is losing money worse than not making money? Now, I've been fortunate enough to be on the inside of some of these hedge funds and investment firms, so I've gotten to see a lot of these professional strategies at work firsthand. And this is what you will learn today, a professional, no BS approach to options. This video is going to be broken up into three sections, three ways that we can use and trade certain options depending on what you want to accomplish. And at the end of this video, I'm going to give you a very important bonus strategy that when I learned it changed the way that I looked at investments. So do watch until the end of the video for that. Before we get started, make sure to hit that like button. Helps the channel a lot. I do appreciate it. We're growing really fast. It's very exciting. So hit the like button and subscribe and do everything that you gotta do. And if you're ready, then so am I. Let's get into it. The first thing we have to understand is what is hedging. Now, you probably heard the term get tossed around here and there. You obviously have heard of hedge funds, but what does it mean to hedge? Hedging can basically be defined as reducing risk in your investments. You are buying an insurance policy on your investment or portfolio just in case that trade or investment goes against you. Your profits are locked in or you are covering your losses. So if you're long a stock, for example, you buy into a stock and you're holding it for the long run, hoping that the price goes up on the stock, and all of a sudden the stock just tanks, it crashes, and you're like, I don't know what to do. If you would have hedged your position, those losses would be minimized or wiped out completely, and even in some cases, you could actually make money on your hedge and end up being profitable overall in the trade. But the basic idea is that you decide that you want to go for less profit potential, but ensuring less loss at the same time. Which goes back to my original question, is losing money worse than not making money? Now, depending on what you're invested in and your investment strategy, you might have different hedging strategies to go along with your investments. So let's go through some of them right now. Now, one of the most straightforward and easiest hedges that one might think of would be to use a stop loss in your trades to, well, stop losses. So say you buy a stock at $50 and then it shoots up to 75 bucks. Well, now you're pretty happy, you're in the profit, you're dancing around, but you're still a little nervous because what if it falls back down? As stocks sometimes do, they go up, they go down. Well, you might be inclined to use a stop loss in your trade by placing that stop loss maybe at $70. So that means that if the stock does come back down from 75 and hits $70, your trade will automatically execute and you'll sell those shares at $70, locking in that profit. Now, this is all fine and dandy, but there are just a few cons that I'd like to talk about when using a stop loss. First of all, you're not guaranteed that that stop loss will execute. For example, if that stock goes from 75 and then overnight has a gap down, going down past your stop loss, well, it's not guaranteed that your stop loss will execute. So you're kind of out of luck on that one. Also, if your stop loss is executed, then you're forced to sell. I mean, obviously, thanks. There's some good content on this channel. No, but hear me out. You're forced to sell. So say it goes from 75 and then it touches 70 and then it goes back up to 72, 75, 77. And then you're like, no, wait, I didn't mean it. I don't want to sell. Take it back. Not to mention there's a lot of market manipulation that is tied in with stop losses. See, hedge funds and big institutions, they have access to see where the majority and concentration of those stop losses are in a certain company. And what do? Well, they try to trigger those stop losses by shorting the company. The company's stock will go down. Your stop loss will be executed. The stock keeps going down and they buy in at a lower price, which is kind of like the opposite of a short squeeze. Relatively rare, but I figured I should mention it. So now you're asking yourself, hey Alex, there's gotta be a better way to hedge our positions. Well, fine, I thought you'd never ask. How can we use options to hedge our positions? The first way is to buy a put on a company you own shares in already. Now let's say you buy stock or you're long stock in your favorite company and you're holding shares for the long term, hoping that the share price rises, you make profit, everything is good. Now let's say that stock has a huge run up in a short period of time. You might think to yourself, yikes, this is a little bit overvalued now. We can't be sustaining this price, right guys? Well, what do you do about it? Well, here's the simple answer. You're going to buy put option contracts in that company which will lock in profits in a different way than a stop loss would. See, when you buy a put option, that gives the buyer the right to sell shares at a given strike price on or before the expiration date. Now, this definition itself of what a put contract is locks in profit inherently in its definition. It leaves room for the upside potential of the stock, but it caps losses. So if you were to buy 100 shares of a given stock at $50, let's say, and the stock shoots up and now it's 75, what you now can do is buy one put contract on that investment, say with a strike price of $70, and that put contract will allow you to sell shares of that company at $70 if it falls below $70. So in essence, you are capping your losses, you are locking in profits, and you know that even if that stock tanks down to $50, $30, $20, $3, you have that right to sell shares at $70. So you're locking in profit right away with that put contract. Now again, remember that one option contract controls 100 shares of the company. So we have 100 shares, we buy one put contract to even it out. We have 200 shares, that's two contracts, so on and so forth. You got it. You guys are smart. Also, another thing to keep in mind is depending on your expiration date, your strike price of your option, how far out of the money or in the money it is, you can actually turn a profit on your put side of the trade. So you don't even have to end up selling your shares, which is great because we know how the stock market works. Something takes a dip and recovers. So you make money on your put contract, you sell that further, you don't need to sell your shares recover, win-win all around, and you make profit. Now, I plan to make a lot of different videos on option strategies and all these intricate little details, so do subscribe if you haven't already. A lot more is to come. All right, now let's take a look at how we could use the same approach but for your overall portfolio. See, it's one thing to watch a particular stock go up and then you say to yourself, there's something not right with that one. But when the whole market goes up as a whole and it keeps going up and there's these crazy valuations and you haven't seen a dip in like forever, you begin to think to yourself, hey, we all just gotta calm down here, okay? So you wanna protect your overall portfolio. You don't wanna sell out of your positions because you're invested for the long term, you don't want to pay taxes, maybe you're collecting dividends. Now, some might say, hey, if you're invested long term, don't worry, don't panic. If there's a dip, it'll recover. Don't do anything drastic. But hey, I say, if you could be a little bit more active and make money along the way, why not? Okay, so what do? Well, the strategy is very simple. We're gonna buy put options just like we did on individual stocks, but we're going to buy it on index funds, broad market index funds, to protect ourselves from the market downturn. We are going to use index funds like the S&P 500 or ETFs that track the overall market, buy puts on them and protect our. So let's take a look at an example right now. Go ahead, pull up your Robinhood app or your favorite trading app, and we're gonna go check out the S&P 500. In this case, we're going to look at SPY, which is the ETF that tracks the S&P 500. So go ahead, go to SPY, and take a look at the 5-year chart. Now, you might look at this chart and think to yourself, well, there's no signs of slowing down. But we all know how the market works, don't we? When we think one thing, the market literally does the opposite. So you might think for whatever reason, there might be a correction coming. So let's pretend this is what we think. Oh, well, there's a correction coming. So what do? So we're going to go ahead, trade options on the S&P. And we're going to go maybe 3 months out in the expiration date because maybe I'm bearish on the situation until the end of the year. I think by the end of the year, something's going to happen. We're going to have a correction. So we're going to try to represent that feeling in a trade. So I'm going to go out to an expiration date, let's say December 17th. Now the option chain will pop up and just make sure at the top you have buy and put selected. You know, it might be on buy call, just make sure it's on buy put. Now, a lot of the times it might be recommended to buy at the money puts. So in this case, we're looking at a strike price at 450 or 451, the closest ones to what the current price is. And the reason for this is that if we're giving ourselves like 3 months for this downturn to happen, it can still go up for a few months before we have that downturn. So that's why maybe at the money would be best. But for me, something like a 5% out of the money strike price would be even better. So we're going to scroll down and we're going to see the 2 break-even percentage that is underneath the strike price on the left. You're going to go down to maybe 5%. So I'm going to keep going down and we see the $442 puts. The 2 break-even percentage is negative 5%. So the SPY has to drop 5% for us to break even on the expiration date. Of course, we can still make money before that. And we're going to click on it and now we're going to decide how many contracts we want to buy to protect our portfolio. Now, there is a formula you can use to determine how many contracts you need to fully hedge your portfolio. I use a little bit of a cheat code here, especially in Robinhood. It tells you the max profit on a trade. And we're going to use that to our advantage to calculate how many contracts we need to protect our portfolio. Now, you might have to turn on a few different settings depending on what brokerage you're using, but a lot of them have the break-even points, the max profit, the max loss. Our max profit for this trade, if we put in one contract, is $42,815. Now, this means that if the SPY crashes down to zero, then we have a put contract worth $42,815. So the max profit shown on the trade should equal your portfolio balance to protect it 100%. So that means if the whole stock or the whole index goes to zero, then you will be fully protected because your max profit will be equal to what you had in the portfolio. Of course, the SPY is not going to zero, so we don't need to cover it 100%. And you'll see what I mean in just a second. But for now, one put contract will cover us if we had a portfolio of 5,000, 10,000, 3,000, 42,815. So in most cases, one put contract on the SPY will be enough to act like a good insurance policy for your position. But if you have a larger portfolio, you might need a few more contracts. So let's calculate what would suffice for a larger portfolio. Let's jump into mine, for example. Now, as you can see, my portfolio is about 1.4, 1.5 million. So we're going to try to protect that using protective puts on the SPY. So go ahead, hit trade options, and let's say we're going to go out till, say, the beginning of next year, January 21st, 2022, because maybe I feel like the market's going to take a little bit of a downturn before then. I'm going to make sure I have buy and put, and I'm going to scroll down and find a good between 5 and 10% for me is good, and I'll go with the 440 puts. Now, for me to cover my whole portfolio, I would need to buy about 34 SPY puts to cover everything. You can see max profit here is 1.4 million. That is, of course, if the SPY just goes to zero, which is not going to happen. So like I said, we're not going to fully hedge our portfolio. I like to divide by 3 or 4 these amount of contracts, and you'll see if I divide 34 by 4, we'd get 8 point something, which let's say 9. So 9 put contracts have a max profit of $381, which is about a fourth of my portfolio. And I am paying about $14,000 of premium to protect my portfolio. Now you'll notice $14,000 is about 1% of my whole portfolio. So with 1%, I can protect the downside of 5 or 10%, or who knows how much it's going to dip. Now this obviously begs the question is, if the market keeps going up and up past my expiration point and nothing happens, then I would have lost my whole premium of the $14,000, but it was 1% of my portfolio. So you have to ask yourself, is it worth taking that risk, paying that premium to protect against a possible more than 1% drop? And that's really for you to answer for yourself and for you to decide depending on the market conditions and how you feel about what's going to happen. Now, of course, you can't keep doing this over and over and keep buying protection for your portfolio. At some point, you're going to run out of cash, run out of money, and it just won't make sense because as your portfolio is going up, you're eating into your profit by hedging your position all the time. Which leads me to my third creative way of hedging our positions: selling calls and buying puts. This is the collar strategy. Now we're getting a little bit more interesting with our plays. Like I said, the problem that arises with the first two strategies that we talked about is you can't consistently do this. And hopefully you could only be bearish for so long or certain periods of time. You can't be bearish all the time because then what are you doing? So how do we find a way to keep hedging our positions if we so need to while not continuously putting up cash? So here is the strategy. You have a portfolio of stocks. What we're going to do is we're going to sell call options on that portfolio of stocks. By selling an option, we're collecting a premium, hoping that that stock does not reach that certain strike price. Now, if the stock does not reach that strike price, we keep that whole premium. It's ours to do whatever we want with it. So we have a company, we're selling calls, we're collecting premium, and then what do we do with that premium? That free money, basically? Well, guess what we do? We go ahead and we use that money to buy puts on our position, hedging with the money that we just took in. See, by adding this extra leg of this trade, we are substituting the cash that we would have had to put up to using somebody else's money to ensure our positions. Not gonna lie, it's pretty smart. All right, so how would this work? Well, let's go in and find the company that we think might be overvalued. I'm going to choose Apple for this example. Now, this is again just an example. I'm not saying it's overvalued, undervalued. Nothing about the company itself, just so we can use it for this example. Let's say we already own 100 shares of Apple. And for whatever reason, we think that it's going to go down this month, next month, in the near future. We want to protect our 100 shares, but we don't want to put up the cash for that protection. So let's see how it's done. We're going to click trade options, and we're going to go out maybe 1 month out. Maybe earnings are coming up for the company, or maybe you think Apple's fall release will be a disappointment. Whatever the case may be, we're going to go, let's say, 1 month out. Okay, let's go to the end of October 22nd. Now at the top, we're going to go sell and call. So we're selling a call, and let's just pick one, for example, $160 strike price. All right, so 160, go ahead, put in 1, and you'll see that you are going to receive a credit of $273. Now that credit is yours to do what you want right when you place that trade and get that order filled. Now on the other side, let's X out of here and let's go to buy and then put at the top, same expiration date. And we're gonna go down and choose the $149 put, okay? So max cost, if we put in 1, you'll see is $291, okay? So it's about the same amount as the credit you're taking in from selling the call you're using to buy the put. Now in this particular case, it's $20 more expensive, but you understand the basic concept. So if we X out of here, I'll show you how to actually combine these two legs into one trade. You're gonna go at the top right of the option chain and hit select. Now you might have to switch these options on in your trading brokerage account, but this will allow you to do different legs at the same time in one trade. So we're gonna go ahead and again hit sell call for the first leg and go to the $160 strike price and select it. All right, so that's the first one selected. Now we're gonna switch to buy on the top and put, buy put, and we're going to buy the 149 put, okay? We're gonna select these two options and hit on the bottom continue, and this will bring up the two trades that we are making. We are selling a call and we are buying a put, and you'll notice that the two option prices almost cancel each other out. In this case, we'll have to pay 16 cents per contract if we want to make this trade, and 16 cents is much cheaper than if you would have just bought that put contract at $2.89, and we're saving a lot of money doing so. Now of course this is just an example, and we chose strike prices that are pretty close to at the money. You can go further out, you can go further in, that's going to be depending on you, but that is the way that we're doing it. We're choosing two options, they will hopefully cancel each other out with its price, and you get a free insurance policy on your Apple shares. Now keep in mind with this strategy, like in all strategies, there are downsides to everything. In this case, you are capping your losses because of the put that we have, but we are also capping our upside potential, our profit potential, because we're selling that call. And if our shares get called away from us, then you are selling the shares at that strike price, so you could only have a certain amount of profit. Now this might be okay for you because during this time period, maybe again, you think that the stock is going down, so you are okay capping your profits to protect your losses for a short period of time. In this case, we did a month or 2 months or 3 months, whatever you feel like doing. So the decision will be yours on when to use a strategy like this and when not to. It is time for my bonus strategy for today's video. It's something so simple yet so effective, and a lot of people don't know much about it, and that is volatility. How can we use volatility to hedge our positions? Now stick with me because it might sound complicated, but it's really not. The S&P 500's volatility is inversely tracked by something called the VIX. The VIX is the volatility index. Now the VIX is often referred to as the fear gauge because when fear is high, volatility spikes up, or the VIX spikes up. Now let's pull up our trading app and search VXX. This is going to track the volatility index, so VXX, and you'll see that the chart for the VIX is inversely correlated with the chart of the SPY. So if we go to the SPY and we look at its chart and then compare it to the VIX chart, it's basically a mirror image. So how do we use this to our advantage, protect our position, and also maybe make a little bit of money? Well, the answer is pretty simple. We are going to buy out of the money calls on this volatility index if you think the market is going down. And remember, this whole video is about, I think maybe the market's going down. So I'm gonna go trade options, and I am going to go out till, say the end of the year, December, or let's keep it simple. Let's go January 21st, 2022. So by the end of this year, beginning of next year, I think the market's going to go down a bit. Again, this is all speculation at this point. And we're going to go and buy the $30 call. So make sure buy and call is at the top, and we're going to go with the $30 strike price. And then you could go ahead, buy your calls, set up your insurance, and you'll be good to go. And this could help offset losses that you might have in your portfolio. And you could even end up making money on those calls, making a profit more than even your losses in your portfolio. And when you sell those options at a profit, then you can take that profit and buy back into the market at a lower price. Your calls are happy, your portfolio's happy, everybody's happy. Give yourself a round of applause, you did it. Let me know down in the comments below what else you want me to teach here on this channel. Like and subscribe, do all that stuff. Get the word of this channel out there. We're new, we're growing, but we are going to grow together. Thank you so much for sticking around and watching this video. I really do appreciate it. You can check out these videos here on options. Thank you so much, guys. Enjoy the rest of your day, and we will see you on the next video.